Regulation of money supply, I would expect that you should know, that is one of the primary function of RBI, and that ensures there is some sort of control on the system so that we don't have too much of money in the system, while the goods and services are not as many. So one needs to understand that how we can possibly ensure that supply of money in the market is regulated to the extent that there is a kind of a little bit extra money is there, creeping inflation as the word they use, is there more than the goods and services, and then how much little bit and where little bit. So I suppose there are two types of checks RBI would do. Is one is qualitative check, and then they have their moral suasion is the word. Moral suasion is basically we can say sort of non-binding, non-legal, non-authoritarian instructions given to the banking system that, hey, take money in this direction. That's a qualitative check that they have got. Of course, there are quantitative checks. That is the check that they do in the supply of money, so that there is like the ADs or aggregate demand and the supply of money has got a kind of planned relationship. It's not like aggregate demand goes very high and the money is not there, or aggregate demand is very low and the money supply is very high, inflationary condition. That they try ensuring that it doesn't happen. And there are so many tools that one can imagine through which this is being organized. Some of them I would like to mention here. I suppose one is that bank rate. Bank rate is like the rate at which commercial banks borrow from RBI. And then imagine if you've got 6.75 as the bank rate now. So if you have borrowing by the banks become more expensive, the banks, commercial banks would give to the market more expensive. That means there'll be fewer borrowing there. Therefore, the supply of money in the market will get contracted, isn't it? So you have got bank rate as an instrument. If the bank rate goes high, the supply of money in the market goes down because the money becomes more expensive in the hands of banks, and then ultimately giving out will also be more expensive. CRR, cash reserve ratio, is another instrument which RBI uses. That means some amount of money which the banks are supposed to maintain with RBI, and then if they have to maintain more money with RBI, there'll be fewer money left in the hands of the bank to give out to the market. So if you have 4.5%, I'm giving certain figures which are the figures which is going on at the time when I'm recording this. If there's a 4.5% of we have got CRR, then in that case, you would find that that much money is less available in the hands of the banks to go out in the market, assuming other factors stand still. So if the CRR goes up, there'll be fewer money. Let's say if it is CRR goes to 5%, only 95 of the 100 rupees will be available in the hands of the banks to take out of the market. So that way we find that's another instrument that we've got. SLR, that's another instrument. A statutory liquidity ratio, that is when we have got the banks are required to maintain certain fund in their hands as liquid asset, and those liquid assets like government securities, etc. And then if they have to maintain that a particular sum, then in that case they would not be having that much money available to be taken out in the market. And then if it is 18%, that means 18% money is held in those liquid assets, which the banks are mandated to do it, and then they have no option of doing anything about it. Another instrument that we got is repo rate. Repo rate is a repurchase option, as one can say. The rate at which RBI can lend to the banks against the government securities and the securities that they have got. This is 6.5%. Imagine the RBI brings down the rate to 6%. There will be more inclination on the part of the banks to borrow more from RBI and give ultimately to the market. So therefore, if the repo rate goes up, then in that case, you would find the supply of money in the market goes down, isn't it? Because the money will become more expensive for the banks to borrow against the deposit of securities. Then we have got reverse repo rate. Reverse repo rate is like when the banks are parking certain surplus funds with RBI, they get some return on that, and then whatever rate at which the RBI has kept the money from the banks, let's say 3.35%. If this rate goes up, there'll be lesser inclination for the banks to go into the market, and then more inclination to go for depositing money. So if you've got money in the banks, RBI that is, if you have got the reverse repo rate going up, then in that case, the banks will feel it safer to park more money in the uh, RBI and then lesser money available to the market. In every case, like you got CRR, bank rate, SLR, repo rate, reverse repo rate, if the rates go up, the supply of money in the market goes down. It's a kind of credit squeeze that we can call it. Credit squeeze or dear money policy, we call it. Like the money in the market becomes more expensive. That's sort of say. Marginal requirement is another tool through which they can possibly do it, like percent collateral requirement for the banks to borrow from RBI. If the marginal requirement goes up, that means the fewer incentive for the bank to actually borrow from RBI. And then quite often this can also be used as an instrument through which the RBI regulates the supply of money in the market. Then also MSF, another instrument is like marginal standing facility. That is basically the banks, when they are in urgent need or they're getting stuck somewhere or overnight, they need some money, and then that rate they at which they can borrow money on a short notice is called as marginal standing facility. There's some arrangement RBI has made that, hey, if you need some money quickly, here it is, but 6.75% is the rate. This is more of an instrument to ensure that the financial stability is there. There's no sudden dearth or supply of money that happens on the end of the banks, which RBI is regulating. And this way, this can also be one of the rate through which the banks can borrow from RBI for a very, very short notice for overnight borrowings that we have got, and urgent needs can be fulfilled in the process. So all these instruments that you have got listed here, these are the instruments through which RBI operates its monetary uh, tools and ensures the desired level of supply of money in the market is maintained.